Hello there. This is Whitney Emmanuel with Whitney Wealth Group, here to bring you a series on recession-resistant investing. So what this means is that there are investments that have downside protections, so that when there is a recession, this is defined as an economic downturn that lasts 4 quarters or more. You have investments that do not correlate with the fluctuations of the stock market. I'm going to be starting by talking to you about cash and cash equivalents, because these are going to be the easiest and simplest way to get started with investing in things that are not correlated to market losses. They do not have variable value that stocks have. Let's talk about what these options are. You've got your checking account, your savings account, your money market accounts. These are all bank insured assets that you can open. We've also got certificates of deposit or CDs that historically yield higher than a traditional savings or money market account. The big differentiator with a CD is that it is less liquid than a checking or savings or money market account. So for this lack of liquidity, banks will try to pay you a higher rate or interest rate. In today's environment, May of 2023, for the term, right now they are paying you more than if you're just in a regular savings account. That wasn't the case just a couple of years ago when we were in a really low interest rate environment. You do not get to lock in a rate with a checking or savings account, but you do get to lock in a rate for as long as that CD term is. So they can be helpful in that way. But a couple of things that you should know about cash and cash equivalents. You have FDIC insurance, which is federally insured up to $250,000 per institution per account registration. What that means is that if you're married, you could have a joint account with a $250,000 limit for each of you. So that would be a $500,000 limit. Then you could have an individual account of $250,000, and then your spouse could have another account, $250,000. So as a household, you have $1 million of FDIC insured assets at the bank, at any financial institution. But you could do the same at another financial institution, but just know as 2 people, you could have up to $1 million. The reason that we want cash is not just because the markets are down. We want to have it in advance of a down market. And the reason for that is because you want to draw from cash when the markets are down, rather than drawing from investments and having to sell them when they're at a lower price. And so cash is your buffer asset in a down market. It's one of the better ones that you could have, because it doesn't, like I said, go down when the market's fluctuating. Cash and cash equivalents are also good to have in an emergency fund, 3 to 6 months of expenses in cash minimum. Keep in mind, a big drawback of cash is that it's a low growth asset compared to other investments. The growth potential is limited to interest rates. Another negative is interest rate risk. You receive better growth when interest rates are high. When interest rates are low, however, cash provides little to no return. So that's why we like to look at more than just cash as a recession-resistant investment, but it is a good place to start. Watch the other videos in the series to learn about your other options.